Equity markets plunged on Tuesday. The systematic correlation of equity markets meant that not only did US equity markets decline sharply, but it also meant many international equity markets were also sharply lower. The main US indices all plunged. The Dow by 3.9%, S&P 500 by 4.3%, and Nasdaq by 5.2%. International indices, although not as steep a decline, were also down, for example, the FTSE and the DAX. The catalyst for the decline was the US CPI report for August, which showed that inflation continues to be a major issue for the US economy. This changed the probability of a larger Fed funds interest rate increase at the Fed's meeting next week, and it also increases the probability of a larger increase at future meetings. Before the CPI data release on Tuesday, the market was somewhat split between whether the Fed would increase interest rates by a further 50 basis points or by 75 basis points. But after the CPI data, the conversation has changed to whether the Fed will increase by 75 basis points or by 100 basis points. Furthermore, the stopping point of the current tightening cycle seems higher than previously. Some are calling for the Fed funds rate to reach more than 4.5% before the Fed pauses. Economic weakness is already showing in the US economy. There was negative GDP for the first 2 quarters of this year, for example, and the fear is that the higher the Fed raises rates, the deeper the resulting recession will be. Recession has been the ending result of all but 2 of the Fed's 9 tightening cycles since 1971. The systematic failure extends to the very data that markets are reacting to and which the central banks are basing their rate increases on. The Consumer Price Index is one of the main indicators for inflation in the US. This data is released each month by the US Bureau of Labor Statistics, and it represents the increase in prices of a weighted basket of goods and services compared to a prior period, usually the previous month or the previous year. There are 2 main components of CPI that are often touted by the press: total CPI, also called headline CPI, and core CPI, which takes out the energy and food components. The data released for August showed that total CPI increased by 8.3% from August last year, which is a slightly smaller increase than the 8.5% in July. However, core CPI increased by 6.3% compared to August last year, which was a larger increase than the 5.9% in July. The idea behind core CPI is that by taking out the energy and food components, which are generally more volatile as they can increase or decrease quickly depending on economic and political conditions, is that the underlying components better determine the longer-term trend of the price pressures in the economy. But this means that core CPI is measuring the price differences of goods and services such as shelter, medical care, clothing and vehicles, both new and old. The largest of these components is shelter, which is approximately 1/3 of core CPI, which is measured not by the rise in housing costs or mortgage payments, but by what the Bureau of Labor Statistics calls owner's equivalent rent of residence. The problem with this measure is that it lags house price increases by 12 to 18 months, and this means that the 2020 and 2021 house price increases are just now getting picked up in CPI data. The bottom line on CPI data, it is not only a lagging indicator, meaning it's data from the past, but that the actual components are very antiquated and they don't capture the true rising prices in the economy. There is no doubt that inflation is an issue in today's economies, and the official CPI data has undoubtedly undermeasured rising prices for many years now. However, our point here is that now the Federal Reserve and other central banks are basing their interest rate decisions on antiquated data sets, and they will most likely overshoot in their quest to bring inflation down, which will in turn cause a significant slowdown in the economy, which leads to high unemployment. And don't let low unemployment figures fool you. The unemployment rate does not generally start to rise until a recession is underway, and unemployment does not peak until mid-recession. All this is an example of the discussion in our recent podcast on what problem does gold solve. Gold provides an avenue to protect our portfolio from financial systematic risk. The rapid rise in interest rates into an economy that is addicted and relies on cheap money is not going to end well. The systematic risks are only starting to rear their ugly heads, and it is likely to get ugly before central banks are forced to retreat into lower rates again, probably by the middle of next year. We end with 2 charts. This first chart shows the relative performance in 2022, the year to date, of gold and various equity market indices. This second chart shows the gold price in various currencies. And for those holding gold in currencies beside US dollars, the returns have been even better this year to date.